Welcome to the Consciousness-Based Business Series, Deep Conversations with Leaders in Business, sponsored by the MIU College of Business Administration. My name is Yeshi, also known as Lingling. I'm a faculty member at MIU. It is a privilege to moderate the session today, joined by such distinguished presenters and panelists. Our presenter today is Dr. Andy Bargerstock. He is certified public accountant and has been an executive with a Fortune 500 company. He established 2 successful businesses and consulted with many companies, including Allstate Insurance, the U.S. Patent and Trademark Office, and the Virginia Department of Social Services. Dr. Andy Bargerstock has received many national awards in accounting. He is an emeritus professor of accounting at MIU. He is a highly respected mentor and friend to many business graduates, including myself. It is our honor today to have Dr. Andy Bargerstock as our guest speaker. In today's presentation, he will talk about how to develop enterprise valuations for small businesses. After Dr. Bargerstock's presentation, we will have a panel discussion. We have 2 panelists today. Our first panelist is Prajol Pradhan. Prajol is a section manager at Washington Suburban Sanitary Commission in Maryland. He has 15 years of progressive experience in accounting operation, financial reporting, and budgeting. He specializes in nonprofit, higher education, and government accounting. Prajol has a master's degree in professional accounting from MIU and also served as a controller at Maharishi International University for 7 years. Welcome, Prajol. Our second panelist today is Lauren Steingraber. Lauren is a graduate of MIU who completed a BA in Business Administration in 2005 and an MBA in 2006. Since graduating, she has spent her career working at the Sky Factory in different capacities. She started in accounting and operations and moved into a leadership role in 2016 as president of the company. Sky Factory is the leading designer and manufacturer of virtual skylights and windows in the world, and their products are featured in top-ranked healthcare networks, as well as commercial, corporation, and in institutional environments. Welcome and thank you for joining us today, Lauren.
Thank you.
Now it is my pleasure to give the floor to Dr. Andy Bargerstock.
Well, a good day to everybody, and I'm happy to be here with you. I have a few slides to guide my 20-minute presentation, and I'm putting my timer on so that I can make sure that I wrap up in time for questions and comments. Ling, you can hear me, right? People can hear me, right?
Yes, we can hear you, Dr.
Good.
Andy.
All right, so this presentation goes back to something that when I got my MBA at the University of Pittsburgh, there was never any discussion about how do you value a private company. There was always talk about publicly traded companies where there were stock markets involved in determining the value of the stock, but nothing was ever said about the private valuation. And so I've taken that on as something that I find interesting, and I'm going to present to you in the short time that we have here today a methodology that was outlined in an article posted on the internet with a private equity firm. Private equity firms help private companies be bought out by publicly traded companies. So this is going to be this presentation on private corporation valuation, the 7 evaluation factors, and we're going to be using some of you who are in finance and accounting, you know what EBITDA is, and we're going to be talking about that model of earnings as it relates to the 7 factors. So how many companies are sold every year in the United States? I couldn't get a solid number anywhere. I don't know that anybody keeps track of it. There's not a requirement for reporting the selling of these companies, but there are many thousands of companies every year that are bought and sold. And the question has to come somewhere along the line. If you're a private company, how much is my company worth? Especially if you're a privately held corporation, and the privately held corporation is only responsible for reporting to the state government, and there's no stock market involved. So how do you know how much your company is worth? There are problems with selling small businesses, and part of that is due to the lack of a liquid market for trading equity shares. People, I would think in Lauren's company, you have shares of stock that are owned by the founders, and some of your employees own shares of stock. Is that right, Lauren? Yeah.
Yes, that's correct.
Okay. So there's no liquid market for that, though. If somebody wanted to sell it, they would have to go to the company and try to figure out if it's even possible that somebody might buy out their shares. So there's
definitely a lack of liquidity there.
There's problems with selling small businesses. Another one has to do with the elevated perceived risk of acquiring a small company or one that's just beginning to emerge in their sector. And how do you determine what the value is of a company that's considered to be perhaps having an elevated level of risk for investment? And ultimately, though, the price that's determined is a negotiation. So what we're talking about today is how do you begin to get a sense of the range of value that your company might have? And we can look to the financial statements to begin to get the data that we need to do this kind of evaluation. Typically, the big picture on valuation of a company is it's usually some kind of multiple of earnings. And earnings can be defined different ways. We'll get that on the next slide. But it would be ideal if we could find a publicly traded company in the same industry that we could compare ourselves to. But that's not always easy to find, especially if the company is in a very highly niched market. And the magnitude of the business could be very different. The publicly traded company could be massive, and the private company could be quite a bit smaller. But generally, if you want to know over the years, I heard this repeated to me many times, that it's usually 5 to 8 times earnings. So the value of the private company is typically 5 to 8 times earnings. And the question is, how do you determine where in that range of 5 to 8 times is the appropriate number to use in generating the math for that multiple? Let's step back for a second and get a context for 5 to 8 times. Why that number? Over 140 years in the history of the United States stock market, stocks tend to trade at price earnings ratios of 15 to 1 on the average. Many industry differences. Many of the industries and sectors will have a much higher PE, and others will have a lower PE than 15. But on the average, that's what it is, which means it really takes about 15 years for a new investor to recover the cost of one share. In the private equity world that we're talking about with private companies, valuations are lower. You can see that 5 to 8 times would be approximately half, or a little bit lower than half, of what the stock might be trading if it were traded in a very liquid equity market. All right, and we talked about the elevated risk of an emerging company as well. So private firms tend to sell 5 to 8 times earnings. And then the question is, well, how do we define earnings? Because there are, different ways you can define earnings. And how do we apply that model of 5 to 8 to crunching the numbers to get a valuation for a company? So there's 7 factors. I found this article on the website of a private equity firm that I found to be a good way of getting your brain and your numbers behind a valuation. So this was retrieved from a website, mccapital.com. You see at the top of the banner there. That's where I got this, and you can go there and you can find this article, the 7 factors article. But here are the 7 factors, and then we're going to unpack each one of them. The size of the earnings. So we're going to be defining earnings as earnings before income taxes, depreciation, and amortization, known as EBITDA. Revenue trends is another issue. How is the company's revenue trending? Is it leveled off, or is it growing? And if it's growing, at what rate? And is it sustainable? Something about the profit margins. How well is the company being managed? How much, what percentage of every dollar sold makes it to the bottom line? Customer concentration and industry concentration are 2 other factors. And then the depth of the management team is number 6. And finally, competitive advantages is number 7. So let's take a quick look at these. EBITDA is an earnings category, but there are many other versions. Different models use different versions. You could have something called operating income. EBITDA is very close to operating income. Or you could look at the bottom line, which is net income. Or you could look at free cash flow, which is, instead of looking at accrued earnings, you're looking at cash flow. So these are different types of earnings models that can be used to solve this problem that we have. We're looking on only one of them today, and that's EBITDA. Earnings before interest, taxes, depreciation, and amortization. I don't want us to get lost on that math too much, but EBITDA is become very popular because it tends to capture controllable cash earnings. And because it does that, controllable, operations managers don't necessarily control interest strategy, financing strategy, tax strategy, long-term financing of fixed assets. That's something that's over a longer time horizon. And if you want to reward something that makes sense in a short term, EBITDA is usually that number that companies will use as an anchor for bonuses. So I had just mentioned these 4 things. Interest expense and tax expense, they are determined by usually the board of directors and the top management team. And it's a long view look at how we manage financing and taxes, not something that is influenced very easily by operation managers. Depreciation and amortization are non-cash expenses. So we want to actually add those back as a correction. If we're starting with net income, then we're going to add back interest expense and tax expense, and we're going to add back depreciation and amortization because they are non-cash expenses. Because we'd like to be able to get, cash is king. We'd like to be able to get a number that we're using that tells us something about how the company is generating cash. So here's the first of the 7 factors. And I got this table from, I forget what GF data is. It's mentioned in the article, but from 2019, the enterprise value in terms of 10 to 25 million, you're looking at an EBITDA multiple of 6. 25 to 50 million is 7, and 7.5 for 50 to 100, and 100 to 250 million is 9.5. So this is just a survey of how the size of earnings is awarded weight in the valuation of a company. Number 2 has to do with the revenue trends, seeking consistent growth of earnings compared to the industry. So you can look at your earnings rate, your growth rate of revenues, compare it to the growth rate of companies in a similar circumstance, and looking at publicly traded companies is perfectly okay to get a sense of how the comparison, how you're doing compared to others in the industry or sector. Profit margins are important as well. Consistent gross margin, gross profit or gross margin, those in accounting and finance, that's the sales minus the cost of goods sold gets to gross profit or gross margin. They like to see numbers here that are at least 30%. This gives you an idea. If you have a gross margin greater than 30%, it indicates good management of your supply chain, product markups, and the existence perhaps of sustainable competitive advantages. And this will lead to higher EBITDA multiples. So that's now number 3. Number 4 has to do with customer concentration. So if you have too much of your sales revenue in one customer or 2 customers, it creates vulnerability, because that one of those customers goes away, it's going to have a dramatic effect on the revenues and the profitability of the firm. So the litmus test from a negative side is if the largest customer generates more than 20% of revenues, then that's considered to be a bit heavy. If the top 3 customers generate more than 50% of revenues, then that is also considered to be top heavy. You're vulnerable if one of those customers goes away. I think you can understand the logic of that. Issues that overcome concentration issues, if your company is a sole source provider to large customers, if they have no alternative but to get products through you, then that is a big plus and can overcome the fact that you may have a large customer or 2. If the company has long-term agreements, contracts with these large customers, that can also be helpful. Item number 5 is industry concentration. And industry concentration, companies that are serving high growth sectors are viewed positively. So if you're serving an industry that is growing very rapidly and the demand for your products and services is high, that gives greater comfort to somebody who might be buying your business. Companies that serve sectors that are growing slower than the gross domestic product are vulnerable. They're considered to be lagging. And currently, industry is growing faster than GDP, healthcare, plastics, aerospace. So those would be some examples of companies that are growing faster than the gross domestic product. Gross domestic product typically grows 2 to 3% a year on the average long term. So if you're growing faster than that and you're serving one of these industries, for example, that's usually a very favorable circumstance. Number 6 has to do with the depth of the management team. So a lot of times entrepreneurial ventures get started by a very passionate, creative, committed founder or entrepreneur. And if that person is still in charge and running day-to-day operations, then what happens when he or she retires after the company gets bought out? Is that going to have a negative effect on the culture and the productivity of the people left behind? But if on the other hand, you have a company where there's decision-making that has been pushed off to managers within the company, instead of all the decisions being made by the founder entrepreneur, that the decision-making has been dispersed throughout the organization, and you have experienced managers that have demonstrated strong leadership capabilities, that's going to be a more favorable circumstance for somebody who might be buying your business. Number 7 has to do with competitive advantages. This means sustainable, durable advantages that protect your market share and the profitability of the firm. And here are 4 examples of what we call, Buffett calls them moats, M-O-A-T-S. That's like the channel around a castle back in the Middle Ages. It's a protection. Intellectual property secrets could include patents, copyrights, trademarks. You could have a brand moat, which has to do with the name of the company. It attracts and retains customers. You could be a low-cost producer, and that would allow you to be you would have a price advantage as a low-cost producer. And then there's a switching moat. Customers avoid switching to different suppliers. For example, my wife and daughters are Apple computer fans, big time. I'm not. And there's nothing, if they're going to get a new computer, there's nothing that I could say that would convince them that they should get anything other than Apple. They have that brand loyalty, and they are very reluctant to switch. So here's an example. We're getting close to our time here. I just wanted to go through this. Here's an example of, and I just created these numbers, doesn't have anything to do with any of my consulting projects in this area, but you can imagine if I went through and I wanted to develop a table like this, where I have the 7 factors down the left side, and then I evaluate the company, and I give them a range of, sometimes the range is the same number, and sometimes it could be quite different. But I take each of those 7 items and I give it a number, usually between 5 and 8. Every once in a while, I'll pull in a 4 or a 9, but it's typically in that range. And so you add the lows up and you get a mean of 6.86, and the highs, you get a mean of 7.43. And then what you do is say, okay, well, what's the EBITDA for the company? Let's say we're going to take a 3-year EBITDA. Let's take last year's EBITDA, this current year's, and then maybe a projection of the next year. You could look at it and say, well, let's just do the last 3 years or the last 5 years. Sometimes, it just depends on who's doing the work. And that's pretty much where I am right there. And these are the numbers. These are the 2 numbers here. The company has a $10 million annual EBITDA, times that factor will tell you what the low part of the range is. And so if you had that company that went through my analysis, I would say that the company is worth somewhere between $68 and $74 million. And now the negotiation begins. So that's the end of it right there. You have, if you were wanting to sell your business, then this would give you the opportunity to have a sense of what the value of your company is. And of course, the seller always wants to have a higher price and the buyer wants a lower price. And they will have their arguments and counter arguments, and eventually you'll end up with a deal, hopefully. So that's it. And what's next?
Thank you, Dr. Bargerstock. And now we would like to hear from our 2 panelists, and then we will take questions and comments from our audience today. Purjo and Lauren, you have the floor.
Thank you, Dr. Andy. This is great presentations about valuation of a small private company. again, private companies, people are very passionate on doing their work and getting those things to the market. But if we don't have any kind of like comparable publicly traded company for that particular business, would they still able to do the same method to reevaluate their companies to sell them to the public, like bigger companies, if they don't have any kind of benchmark to do in a market?
Well, the world is always presenting those challenges, and we have to adapt to the data that's available to us.
That is true. That's
So
definitely true.
you may, depending upon the nature of the business, you may have a company that is very similar to what you're doing, and you can say, boy, this one's very similar. But that's usually not the case. There are usually some differences in scale, differences in technology, differences in the approach to the marketplace, and the ways in which they try to take market share from their competitors. There are a lot of differences usually in place that won't make it an exact fit. So you do the best if you can find something that's close, that's great. And if not, there are databases available. The Risk Management Association provides an annual list of ratios and percentages of companies according to SIC codes. They're actually the NAICS, North American Industrial Classification System. And so you can very easily, if you were looking up a company, you can very easily just do a Google search on what their NAICS is, and that will give you a number, and then you can go over to the Risk Management Association database and look up companies that are in that sector and get data on some of these key financial measures.
Thank you. Following up with the same thing, if like in last 2 years or so, there's a lot of numerous retail investors coming into the market to look for the opportunities, right? This could be one of those things. So all those retail investors, should they do their homework, like this kind of homework, before they invest into any company? Right?
I can assure you, any of them of any size and magnitude, there's somebody crunching the numbers. Somebody's doing the forecasting and the estimating. And you know, the future is never exactly like you think it will be. That's one thing for sure. You can come up with estimates and projections, but the future isn't going to usually be that great. And it'll be different in some way because there's so many uncontrollable factors.
That's true.
Like what if there's a sudden decline in the stock market if you're a publicly traded company? You know, you may be doing a great job running your business, but suddenly, you know, your stock is down 30, 40%.
Absolutely.
And it has nothing to do with the real value that you're producing.
Absolutely, yeah. So looking at this EBITDA, EBI,
Yeah.
TDA,
Mhm.
it will look for their operational strength. But to have a complete picture of any kind of business, we need to look more than that, right? Definitely, there's a cash flow, all the things that we do discuss earlier too. So EBITDA will give us a comparisons, but the whole full picture, to know that company's whole full picture, you need to look for the other financial statements. Do you agree with that?
Yes, absolutely. We need to look at return on equity, return on invested capital, return on assets. You want to look at the trending last 3 to 5 years on revenues and profits, and all sorts of different analysis can be done.
Yeah. Thank you. That's all I have. A question for you, Andy.
Thank you.
Thank you, Purjol, for starting up the conversation. And perhaps we can also get Lauren's points of view.
Sure. Yeah, my first question was, Dr. Bargerstock, in the example that you used EBITDA as the basis of evaluation, but mentioned that other measures could be used, such as free cash flow or other profitability measures. If you chose to use, cash flow as an example, would you still use the 5 to 8 times multiple, or would that vary based on what your base measure is?
Well, the 5 to 8 is just kind of a general range. I talked to a friend of mine who has been working for 7 or 8 years with a private equity firm, and he told me that some of the smaller companies will actually be sold more in the range of 4 to 6 times earnings. We saw a table where it started with $10 million in the valuation, but what if a company is much smaller than that? And
would generally a smaller then be even lower than that, like the 4 to 6 range, like you?
It could be 4 to 6 times earnings. This is what he's telling me.
Yeah.
And the whole thing about it is you have to have a compelling story. So, for example, many of you or some of you know about the company Books Are Fun that used to be in Fairfield, and it was bought out by Reader's Digest in, I think, 1999 for $385 million. And they were producing about $40 million a year in profits. So you can take 385 and divide by 40, and you can see that you've got something north of between 9 and 10 times earnings. And so why were they willing to pay that amount? Well, part of what happened with that company was they had created a niche to be able to go into companies and sell products in the workplace. No one had been able to figure out how to do it. And they did it in the form of book fairs. And they started in selling books to teachers and administrators in public and private schools. And then one year they had a lot of excess inventory, and they went up to Iowa City and they did a book fair at one of the major hospitals, and it was a smash hit. And they realized they had another line of revenue that could be exploited. So I ended up being over that half. That was the book fair division. And I was over that division, and it grew that, and it was really a wonderful experience. But, this whole thing is at Books Are Fun. Now, I'm trying to remember why I was bringing up this example. What was your question, Lauren? Remind me again.
Oh, that it was 9 or 10 times earnings.
Oh, yeah, the 9 or 10 times.
Yeah.
So what they did is when they were pitching Reader's Digest, they had started a jewelry division and an art division. And they had a small group of people who were doing art fairs and jewelry affairs. And what the pitch was by Books Are Fun is that we've discovered how to get these events approved in corporate America. We have this network of independent reps and our telemarketing group that knows who these people are. And the big success we have in books, we think we can extrapolate that over to these other product lines. And so there was
lots of growth potential.
A lot of growth potential. And so that's part of the understanding of why Reader's Digest paid between 9 and 10 times earnings. Now, you know how long it took Reader's Digest to get their money back? 1 day. It took 1 day, because when they closed the deal and they brought the assets and the revenues into the Reader's Digest company, they were bringing it in at a multiple of about 20 to 1. So they doubled their money in one day. Pretty good.
Yeah. That kind of dovetails into my next question. Out of the 7 factors that you mentioned, Andy, there were a couple that were more qualitative, I would say, than quantitative, such
Yes.
as competitive advantages and the management team depth. How do you go about evaluating those factors that are maybe a little bit more subjective?
Yeah, well, that's going to take place through conversation, through a narrative analysis. And you say you've got decision makers placed throughout the organization and you don't have all of the decisions coming top down, prove it. You know, and that'll be part of what happens during the discovery process and the due diligence that takes place. Prove it. And there'll be interviews with employees, confidential interviews. Come on, you know, I'm not going to reveal what you tell me, but I need to know this. It's important. Yeah, how would you characterize the decision-making process in a company? Is it a top-down or is it distributed? And we have good leaders throughout the organization. You know, where is it in that scale from one end to the other? So a lot of that is going to be that way. And then, you know, sustainable competitive advantages. Well, you say you have competitive advantages, but prove it. You know, give me a reason to think why you say you have a switching mode, that when companies you buy your products, they're reluctant to switch to a different provider. How do you know that? Have you done surveys? Have you done focus groups? What's the data that supports your proposition here, that you have, you know, a solid switching mode where customers want to stay with you? You know, all I can tell you is the anecdote of my wife and my daughters. Well, that's just an anecdote. Give me something that I can hold on to, that it's going to convince me. You think Apple has such data like that? Do you think, you know, that happens with Apple? You know, if you had to put their feet to the fire, they could show you lots of data that supports the anecdote that I just told you about, where people who they buy a product from Apple, they want to stay with it.
Right, and the whole factor of proprietary software that integrates, you know, devices and so forth. That would be a barrier to switching, as an example. Yeah,
the operating system is patented, and a lot of the technology and hardware is patented as well.
Knowing that there are many valuation systems out there, if a company wants to be sold, how do you go about starting a negotiation?
Yeah, well, the question is, if you want to be sold, how do you let people know that you're available to be bought? And
also, how do you know where to start with the in terms of the numbers? How do you start to come up with a price?
You could go through a process like I just showed you to get a sense of what the range is. You could get a private equity firm who does a lot of this negotiation and analysis, and you could have them give you their opinion on it as well. You have to get the word out so that you can shake the bushes and get some people who are interested and see what they're thinking.
Are there any situations aside from a potential sale that a company might want to, you know their valuation or use that?
Well, let me throw that back to you.
Okay.
You know, you guys are a local company, and what would you think? What would you think would be reasons that it may be important for you if you're trying to get a bank loan?
Right.
And
yeah.
And you know, and everybody knows that the book value is a historic number. Well, what if you were going to sell the business? What would be the value of that business? It's probably going to be higher. And, you know, you can get some appraisers to come out and look at your assets, but if you have a calculation of what the value of the business is, it could help secure some loan financing for expansion of the business.
Yeah. I also feel like with the system that you've, you know, gone over today, that it's fairly well rounded and that it looks like at a lot of different measures of a company. So even as a manager, just to get a pulse on your company and how it's doing, I feel like doing this process, of course, you know, it's harder to do it in a objective way as a manager, but I still think that going through this process and evaluating how are we doing on our profitability, how are we doing, you know, in terms of our management team depth, et cetera, is actually a valuable reflection on how you're doing as a leader in your company. And I know Sky Factory, we're an open book management company. And so our finances are open to all of our employees as a way to give more transparency and involvement of all of our employees. And we've engaged with Andy a few times over the years to do financial literacy training with our employees. And we've looked at the systems evaluation and found it to be a really helpful tool.
Yeah, those have been fun times. You've got a good group of people over there, very committed, and take a lot of pride in the quality of their work.
Yeah, thank you, Andy.
Thank you, everyone. Thank you for this very exciting and thought-triggering discussion. And now we would like to take questions and comments from our audience. And actually, we already received quite a few really good questions. I will start with Megan Anderson's question. And she said, in her comment, she said, this was a great topic and so helpful. And building a company is a fast-growing segment, and this has helped me today to understand my own metrics and to understand how am I performing. Her question is, how effective is this line of thinking in terms of creating a sustainable business to set up for acquisition? How can a startup structure a measurement of its true performance and align the team compensation to that strategy?
Read the last two sentences again, if you would.
Sure. How can a startup structure a measurement of its true performance and align the team compensation to that strategy?
Yeah, you know, one of the things when a company is young and it often is underfunded, typically scrambling for cash and underfunded. It takes a few years for a company to actually create market share and to manage its profitability so that it can be successful. One of the things that you need to do as you become more mature is pay attention to some of the key financial ratios. Harvard Business Review has a book, I can't remember the name of it now, but Harvard, you can find it on Amazon, and this would be Financial Statement Analysis by Harvard Business Review. I think it was written around 2013 or so, and it's still relevant. And you know, for maybe $10, you could get a used copy of that, and that would give you the ability to understand the kinds of ratios Prajwal was talking about, the kind of ratios, other ratios beyond what we talked about today, that you need to be tracking to measure the effectiveness of the management of the business. Let me give you one example. Banks stop lending money typically when there's more than 65% of the assets that are being financed by debt. So if you have, you can simply take a debt to asset ratio. Debt to asset ratio. And if that's 65% or higher, you're probably going to have trouble getting bank financing. And if you do get bank financing, they may have a lot of conditions requiring security for repayment, and the interest rate may be higher. So you need to know some of these ratios that banks are going to be looking at. If you want to grow your business in the future, you don't want to have too much debt. And so 65% is the number. It's better if it's down around 40, 45%. So that's an example of you educate yourself about financial statement analysis in a book like that you can get very easily at Amazon. I think it's the only one where it was Harvard Business Review and financial statement analysis. You'll find it very quickly when you go over to Amazon under their books section. And that would be a good one for anybody who wants to really get educated on these key ratios that investors look for and banks look for as well. I hope that's helpful.
Thank you, Dr. B. And there is another question from our audience. It's from Emmanuel Scattinger. I think his question is a great concern of a lot of the students majoring in sustainable management. He asked, with climate change and concerns around sustainability becoming more and more of a concern, how do sustainability considerations around ESG and CSR's corporate social responsibility factor into this financial decision?
Well, thank you, Manuel. It's good to hear that you're still involved with the business department there. And of course, every company has its own approach to sustainability. And I'd like to open that one up to Lauren. Lauren, does your company address any of these issues of sustainability and environmental? I think you guys are pretty aware of some of those things.
Yeah, we, that is a big factor in sort of our organizational culture, and something that we're always wanting to look to improve upon, I would say. We're solar powered, and we look at in terms of producing as little waste as possible in our manufacturing processes. But I would say that, for either a buyer or a seller who wants to factor in sustainability, I would think that you could add an 8th factor to the system that Andy just presented on today, and potentially, come up with some system for evaluating sustainability of an enterprise and factoring that in, because I absolutely agree that it's a very important and pressing factor to consider.
Once you take that, make that a part of your culture, it is amazing the effects that it has. Now, Lauren, you unmute your mic again, because I'm going to give you guys a real pat in the back, because you have a profit sharing plan with your employees, and there's certain things that have to be done by the end of the month, every month without fail, or the profits don't get distributed, right?
Yeah, so I mentioned that we have an open book management system, so everyone in the company is able to see the financial performance of the company. On top of that, we have a profit sharing program. So basically everyone has a stake in the outcome of the company. And so 50% of the company's profit on a quarterly basis is distributed amongst all the employees.
So that's on a quarterly basis.
Yes, quarterly. We switched it from monthly to quarterly just to simplify things for us. But basically, yes, we have different factors that we have or contingencies, I would say, to paying out those profit sharing amounts, which is cash flow measures, customer service in terms of on-time deliveries and ship dates, and other factors. You could really tie, anything that's important to your business to that type of system.
Yeah, the thing I was impressed with is that, and now I don't know how long it's been, Lauren, but virtually every year you end the year with zero inventory. In terms of, you don't have any work in process.
Yes.
Everything is shipped.
That's correct. Everything we make is basically built to order. So, we have raw material inventory, but we have zero finished goods on hand at the end of the year. And, obviously we have work in progress that's on our shop floor at any given time, but we basically build everything to order and ship it out in order to minimize our inventory and be as lean as we can be,
Yeah.
and not build products that don't ultimately get sold and that kind of thing. So
Wow,
and
that's
people
very
in
impressive.
people in the company have been cross-trained to be able to come out and help the people in the assembly area as we get towards the end of the month, if it's looks like we're going to be pinched to get the product out on time.
yeah, so I would say as a small business, flexibility is extremely important to be able to react to, current needs in the business. And so, yeah, within our production team, we have cross-training where our goal is to have everyone in the production team know every process. And that's, a lofty goal, and it's not always the case, but we're continually working on cross-training. And in addition to that, like Andy said, if we're in a situation where we need to meet customer deadlines and we're shorthanded, our office staff will go back and help with some of the simpler tasks that in order to get product out on time and meet the customer demands.
Yeah, it's just now the Sky Factory was cited by Inc. magazine as one of the best places to work in the United States. What year was that? Do you remember?
Oh gosh,
The 2008,
maybe it was
2008
or 2009, something like
I
that.
think it was
Yeah,
somewhere in there.
somewhere in there.
Yep.
And thank you, Dr. B and Lauren. I believe some of the areas that perhaps we might explore more, and you're giving us clearly some very good indicators of the future discussion that we need to have. And because of time constraint, we're going to take a final question. And for all the questions that sent in today, if we are not able to answer during the seminar, we will answer it individually and send it back to you. So the final question for Dr. B and our panelists today is, what are the reasons that a company, other than the obvious one of selling the company, would need a valuation? Who would like to take this one?
Well, we talked a little bit about that, and we asked Lauren about, when there would be a need for valuation. We discussed, remember, perhaps if you had a need for financing a debt, that valuation might be important. If you're thinking about trying to sell your business, but you're not actually into it yet, knowing the range of values could be helpful to you in deciding whether it's worth your while even to pursue a suitor to come join it. Anything else that you can think of, Lauren?
I suppose if you were looking to bring on equity financing, aside from selling the whole enterprise, if you wanted to, rather than look at debt financing to bring on some partial equity share, then that would be an occasion where you would need to look at the valuation of the company. And like I mentioned, like I mentioned in my comments earlier, just simply as an internal measure to see how your company is performing.
You have people out in the marketplace who are observing, let's say in your example, if they were observing the high quality of the products that Sky Factory produces, and they've seen installations in various public buildings, and they've researched it and said, well, who are these people? And they get really intrigued, and they find out more about it, and they get that Inc. magazine article, and they go, wow, this company is really forward looking in a lot of ways. Maybe I should pick up, maybe I could acquire 5 or 10% of that company. So that could be something short of a full sale of the whole property, of the whole business. You would still be a private company, but somebody would be taking an equity position.
Or partial equity ownership. Mhm.
Thank you. And although our time is limited, but I would hate to skip this question. So this is the last question for today in our live discussion. And Dr. B, you may have touched on this in your presentation, but in general, in business valuation, how should companies account for capital expenditures or capital assets that may be obsolete or aging? For example, when looking to buy a building along with the business, if one uses only net cash flow and a cap rate valuation, one isn't taking into account future replacement or repair cost. So in that scenario, do you look for set appropriate maintenance accounts on the books and the corresponding cash in the bank?
Yeah, if a company is involved in intensive long-term asset acquisitions to build capacity, then they may want to consider the free cash flow model rather than looking at just EBITDA. Free cash flow starts with operating cash flow. So that's cash basis profits. And then you deduct the capital expenditures. So, and the capital expenditures are in essence, you remember we said depreciation is not a cash expense. So when you get to operating cash flow, you haven't deducted depreciation expense, but you could bring in and say, well, let's actually deduct the amount of money that we have to invest in our company. And that would be the amount of capital expenditures every year. And that's easily available. That number is easily available in a publicly traded financial statement in the operating, in the cash flow section of the statements. So there's always room. That's why you have to decide which you feel will be the most appropriate measure of earnings to use in your evaluation.
Thank you, Dr. B.
Hey, Ling Ling, do you know
Hi.
about how many other questions do we have?
We have, I think the questions in the chat box, we have about 5 or 6.
You want to send them to me and I'll be glad to create a response?
Sure, we will do that. And as a closing session, Dr. B, do you have any final words for business students and young professionals?
I'd like to pass that to Lauren. Lauren, you knew I was gonna, if we had a little time. Here's somebody who went through our MBA program, and is there any tips or guidance that you might want to give to the students about your how your MBA helped you rise up to become the president of this company?
Sure. I would say that MIU gave me a great background for my current role, just in kind of giving me an overall strong business education. You know, I started off in more of a finance area, and I think the skills in terms of financial analysis, looking at systems and how to make data-driven decisions has really helped me grow in my role working within a small company. And on top of that, I feel like I got a really good background on how to think big picture and look strategically. And yeah, I think that about sums it up.
Thank you,
Thank you
Lauren.
very much.
Thank you.
Thank you.
And with that, now we're entering to the reflection time, and please Please, for our attendance, our audience today, students, please input your takeaway point, your reflection point on today's session, and you may enter it in our chat box. And everyone, thank you very much, of course, first to Dr. Andrew Bargerstock for this excellent presentation to our session. And again, I want to acknowledge and thank our panelists, Projal and Lauren. And also a big thank you to everyone that joined us today. We also want to acknowledge and thank Ayako and Viola for organizing and facilitating this great series. And a recorded version of this webinar will be available on MIU's website and MIU's YouTube channel. Do not be shy. We would love to hear from you. You may also post your questions there. And we hope you will join us again for the deep conversations with leaders in business and sponsored by the MIU College of Business Administration. Thank you all.
Thank you.
Thank you.
Thank you very much for giving us the opportunity to talk.